Yeah, the fear is the dollarization of the consumer and the domestic economy. Like the dollar was always the rail for international, but that's increasingly changed. But in stablecoins, the dollar dominates. So surely the way to push back against that is to ensure that your sovereign currency and indeed your commercial paper becomes available on chain. And that was my argument in why every bank should tokenize deposits is there's a land grab going on here. The genie doesn't go quietly back into the bottle. Now is your time to really make a difference and really get on the front foot. And indeed, it looks like tokenization is a genie that's not going back in the bottle more broadly. Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name is Simon Taylor. I am your host for today, author at FinTech Brain Food and GTM over at Tempo. Right, let's introduce our guests. First up, making however many times he's been on the show now, his umpteenth return, is Chris Harmse, the co-founder of BVNK. How are you doing, sir?
I'm very good, Sire. I'm starting to feel like part of the furniture at this point, but thanks for having me back on.
Well, you should stop being a good guest. I think that's otherwise you'll become furniture. No, far from it. But we're also excited to be joined by Eric Piscini, who's CEO of Hashgraph. Thank you so much for being with us. How are you keeping, sir?
Very well, thank you. Thank you for having me. Happy to be here.
Likewise, sir. Likewise. Right. Just before we get into the news, I've got two quick bits for you. We are incredibly close to our first ever live tokenized event on the 11th of September in London. Tickets are completely free. Thank you to our sponsors. So to register, click on the link in the description, wherever you're watching and listening. And also, especially this week, I need to remind you that views and opinions of contributors and hosts are their own and might not reflect those of their employees or companies they represent. Please don't take anything we say as tax, financial, legal, investment, sports, any other kind of advice. Please do your own research and stay safe, folks. All right. There was a lot of big news this week, but we're going to start off with this story from Fireblocks launching a stablecoin payments network. The firm announced it was launching a network to let crypto financial firms more easily move stablecoins between one another and build stablecoin products. The network's got apparently 40 participants, including Bridge, and many others. Members include Zero Hash and Yellow Card. Chris, my resident stablecoin expert, what problem do you think this is designed to solve? And do we need these type of networks? Do you have a good feel for that?
I mean, I think it feels like every other day some new stablecoin payments network pops up. Whether that's a blockchain or a network itself. But I mean, when I look at these things, I'm kind of sitting back and watching and seeing which one of these. Well, firstly, how they come to market, and secondly, which one of them can actually get to scale. I mean, our business over the last 6 years, we've been building a rail agnostic, stablecoin agnostic, payments platform by design. And, I think really, it allows our customers to access any one of these networks, whether it's a layer one, a layer two, some network built on top of that layer one. We kind of see them as additional nodes. So yeah, it's going to be interesting to see. I don't know kind of what's the difference between this one and Circle Payments Network that just recently launched. So it'll be interesting to see where we get to. But I think one of the things that we're watching is the story as more of these things come to market, these networks and layer ones, layer twos, all focused on payments and stablecoins. I think the real story that maybe the story behind the story is kind of fragmentation. Is you ending up with more liquidity fragmented on more chains within more networks instead of kind of coalescing around one or two or three major networks, which obviously has benefits and kind of disadvantages. But yeah, it's going to be interesting to see. There's not too much detail out on this Fireblocks one, but yeah, it's kind of wait and see mode for me at the moment.
Yeah, it's so hard to tell with these things, isn't it? That's very, very difficult. Eric, do you have any views on this one and the role that some of these folks might be taking here?
So I don't know the specifics either, but I would agree with Chris. I think that the challenge here is going to be network effect and how big those networks can become on their own. I would not be surprised if the large incumbents, Visa, MasterCard, American Express, would at some point jump into that stablecoin wagon and create their own, and they do have the distribution channels for sure compared to the other incumbents. So I think we're going to see even more fragmentation. Chris, I don't know if you agree, but I think we're going to see even more fragmentation coming from traditional players before it gets to a consolidation state. What we do here at Hedera Hashgraph, we build stablecoin, what we call stablecoin studios. So we build the tools for people to use stablecoin on our network. And we see, even at our level, we see fragmentation of players. So I think it's going to be a wild ride before we get to a stable situation for stablecoin.
A stable situation for stablecoins, too much fragmentation. Well, Eric, speaking of fragmentation, you had some news this week. There's lots of people been doing things in Wyoming, including your good selves. Do you want to tell us about it?
Yeah, thank you. We just announced, actually, this morning, US time, we announced the launch of the Frontier stable token on Hedera. So that token was launched on other blockchain earlier, and we got selected to be a part of that as well. So exciting for us because it's the validation that we have the right technology and go-to-market activities to be recognized as a valid platform for stablecoins.
It is. I think that power laws may play out a little bit here, and kind of being in the place with governments is fairly unique. Chris, how do we start to solve some of this fragmentation? I know it's something that you sort of wrestle with inside your own business. And do you think that, the Oprah meme and everyone gets their own stablecoin and everyone gets their own network can last forever? Or is there something we can be doing? I know the folks at Layer Zero, for instance, would have a take on this, and many others. Like, are you seeing that in your own business being helpful? Are we solving the fragmentation, or does it get worse before it gets better?
Yeah, I think, that meme is probably true at the moment, the Oprah meme for networks as well as stablecoins. I think for us, we always bring it back to the customer. So whether that's a merchant, an end consumer, or a merchant serving an end consumer, and going like, what needs to be true in the stablecoin payments world for stablecoin payments to get to the scale of traditional payment methods, either like cards or APMs? And it can't be more choice, more complexity, more rails, more stablecoins. It's got to be less of that, or at least some system or platform similar to what we've built that obfuscates all of that complexity away, where you can come and pay in any stablecoin on any chain, and our system will pick that up, pick up what chain it's on, convert that into any other stablecoin and any other chain, or even fiat currencies. And I think that, being able to abstract multiple networks and multiple different stablecoins, and moving them, between different blockchains is quite important. And that's really what our platform does for large enterprise customers on our, hey, you want to accept stablecoins? We provide access to all of these blockchains, all of these stablecoins. Your consumer can pick and pay with anyone. You will end up with the one that you want. So I think as this fragmentation increases, platforms like ours become more valuable in terms of being able to obfuscate that complexity. So I think you probably do find a kind of saturation point where the market settles, and then you probably start going the other way and start consolidating a little bit again. But yeah, that's kind of how I see this playing out. It's very like everyone gets a network, everyone gets a stablecoin at the moment. You get to some sort of peak complexity. We have to kind of reduce that complexity, and through that you get consolidation again. And that's kind of my mental model as I think through, all of these networks and new stablecoins coming to market.
It's fascinating, isn't it? I think there's good use cases for treasury management internally. As I think about this as somebody who was a transaction banker, it was quite common for somebody in their ERP to set up something called an in-house bank and to be managing treasury functions across their various divisions, but waiting for their nostros and their correspondent banks to be able to settle that was always particularly slow, and we never really solved that. And there are good closed loops like Connexus and Citi token services that can help you with your treasury. But stablecoins are open loop, but they're almost at the opposite end of the spectrum on the risk curve. Not everybody's going to be ready for that yet. And I think there's a gap in the market for things that help close that somewhat. It's fascinating as well. And I wonder if, a bit like the AI startups, are we in the MySpace era still, where there's a million different AI startups, and they've all got insane revenue, but what's the moat? Who's durable? And sometimes when it looks really big, you think, well, there's nobody going to challenge that incumbent. And then somebody comes along 2 years later and is Google. Somebody comes along 2 years later and is Meta. Apple always launches a little bit later than everybody else, and then in the end wins. So, yes, there's a lot of networks. Yes, there's a lot of fragmentation, but markets have a way of forcing these things around. And as I think about it from first principles, there's only so much fun you can have on your own blockchain, definitely. But blockchains themselves did need to be upgraded for payments. That's one of the reasons I joined Tempo. I mean, Chris, you've probably experienced this. General purpose blockchains have a noisy neighbor problem. When a Trump meme drops, then payroll might get delayed or settlement could be pushed back 24 hours. Now, it's great to have these general purpose chains because what you get is the ability to have programmability across different types of asset classes. We want that. That's a great thing. But as I think about it again from the first principles of finance, we always separated the infrastructure of the cash leg from the other side of the transaction. And that broke DVP. Don't get me wrong, it wasn't perfect. But I think we can do better. And I think if we work together on that, we can. So that's why it's important that we're not too pointy-elbowed when this market is so small, that we do invite quasi-competitors to start to collaborate and really work together on some of this stuff. So it's going to be fascinating to watch. I'm going to pause us here for an ad break, bring us back in, and we're going to talk about banks in Asia. So let's do that. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. This episode is sponsored by Bridge, a Stripe company. Just as the internet made information global, stablecoins are making money global. Bridge, a Stripe company, is the infrastructure powering that shift. It's built for speed, scale, and simplicity. Bridge helps businesses send, store, and accept stablecoin payments instantly. You can serve global customers without navigating the complexities of setting up those crypto rails. It's how companies like X, Shopify, and AirTM unlock new markets, reduce their FX costs, and move money at internet speed. Explore the future of global financial infrastructure at bridge.xyz. Tokenized is also sponsored by Fireblocks. Fireblocks is the stablecoin infrastructure of choice for global businesses from Visa to WorldPay to Bridge to Revolut. With over $100 billion in monthly stablecoin volume, Fireblocks powers stablecoin strategies at scale with infrastructure that enables PSPs, fintechs, remitters, and banks to issue, move, hold, and manage stablecoins. It's all done securely at scale with secure built-in compliance. With Fireblocks, you get complete control to build your own stablecoin orchestration layer, create payment accounts, manage liquidity, and access on and off ramps in over 60 currencies. It makes it easier for you to build and scale and expand your business globally. Learn more at fireblocks.com. All right, thank you so much to our sponsors. I don't know if you guys saw this week, but there were a few headlines that really caught my eyes. Firstly, Japan Post Bank considered launching tokenized deposits. Korea's K-Bank launched its own stablecoins, and 77 different firms applied to issue stablecoins in Hong Kong. Chris, APAC is a region that keeps coming up, but do you think this region's poised for an explosion of growth, or it's where the growth has already happened? Help me understand your perspective on these stories.
Yeah, I mean, I think, APAC's always actually seen great momentum. I lived in Singapore for 6 months in the early part of 2023, just kind of networking in the region, hiring our early team out there. So today we have, 4 or 5 people on the ground in Singapore. We're at the final stages of getting an MPI license from the MAS. And I think, Hong Kong is leaning into getting a pragmatic, there's been long been one in Singapore. It's taken a bit of, time to kind of get through that application process, but Hong Kong's kind of brought in their own regulation. So, but besides that regulatory clarity that's happening in APAC, there's always been very strong demand for crypto. And when we started our business, 6-7 years ago, we saw a lot of demand in APAC. We were actually doing the stablecoin sandwich. We would collect in Asia and settle in Europe using USDT, which was really the only place you could do those sorts of payments at scale with liquidity. So it's actually been an epicenter of stablecoin payments, in my view. And maybe kind of as the rest of the world started leaning into stablecoins across Africa and LATAM and the US and Europe, maybe lost a bit of its shine. But I think it's squarely back now, and we're seeing a lot of demand across large enterprise customers in Asia, but also digital wallets, which obviously proliferated quite well in Asia, starting to lean into adding stablecoins into their wallet. So I think it's a really exciting time in Asia, and a lot of really interesting stuff happening across the space.
Yeah, South Korea has always been a really interesting big player in the crypto markets generally. And what's fascinating about their new administration is they are quite pro-crypto in a lot of ways. But we're seeing the beginnings of financial institutions doing currencies pegged to the local Korean currency, but backed by US treasuries. That's fascinating. I don't know that I've seen that model really play out before. And this is kind of like if that did happen, it would prove Scott Bessent right that there is potentially more demand for treasuries and different types of backing. We also saw the deputy from, I forget the exact title, Sarah, somebody from the Bank of England, apologies folks at the Bank of England, announced today that they're open to looking at how your sort of UK government debt could be solid backing for a portion of stablecoins in circulation. So the regulatory clarity that's coming outside the US as a result of the new US regulatory clarity is an unlock that I didn't predict, but is truly fascinating. And Eric, obviously, you've been quite close to how one state in the US is thinking about this. How should we think about this as kind of nation states level? What are the benefits to stablecoins, and are there risks there that they should be worried about?
Yeah, I think besides the fragmentation we talked about earlier, I think the other challenge is it's part of a monetary policy at the country level, right? So do you push your own currency to be more innovative, and stablecoin is one way to be innovative, because you want to protect the sovereignty of that currency in your region, in your country. I think that's a real discussion that's happening in different places. So you can apply that at the state level. And Wyoming is a little bit of a unique situation, as we all know, but you can apply that at the country level. And that's where I think you're going to see more activity in China, in Japan, in Europe, probably as well overall, because of the fact that many of those stablecoins are sitting today on the US dollar.
Yeah, it really is interesting to think about the geopolitics and the currency controls. Chris, I guess there's been a lot of African states that have worried about that historically, but have you seen that sort of start to shift and change? Is there an accepting of reality going on? Is there just a lot of entrepreneurialism happening in the global South generally, and it's pretty hard to fight that trend, and maybe you've got to wrap your arms around it a bit?
No, I mean, I think historically we've seen governments look at like, the dollarization, if you want to call it that, of their economies, obviously with heavy skepticism, and stablecoins have been a way that, a technology that's accelerated that trend, and they need to respond somehow. And any African government or other government does not want to lose control of their currency and get their economy dollarized. So I think they are leaning into, hey, what does it look like to issue my own stablecoin? Be innovative, as Eric said, and maybe get that stablecoin trading against the dollar stablecoin. And then, we've spoken before, then you start getting into the on-chain FX scenario where you can start, settle and execute at the same time, which gets quite interesting for, settlement finality and, releasing some trapped capital stuck in these Nostro Vostro accounts. So I think there's a lot of things, but I do see, slow movement, and maybe it will pick up some steam of nation states looking at, issuing their own stablecoin, getting their own stablecoin on chain. You had a great blog post about bringing, tokenized deposits more recently on, and other things on chain and why that made sense. So I think bringing deposits, bringing, local domestic currencies on chain and being innovative around that makes a lot of sense. And I do think, secretly or not secretly, quite openly, there's trying to protect against dollarization of the economies as the dollar gets exported to more places around the world through stablecoins where it couldn't do that before.
Yeah, the fear is the dollarization of the consumer and the domestic economy. Like the dollar was always the rail for international, but that's increasingly changed. But in stablecoins, the dollar dominates. So surely the way to push back against that is to ensure that your sovereign currency and indeed your commercial paper becomes available on chain. And that was my argument in why every bank should tokenize deposits is there's a land grab going on here. The genie doesn't go quietly back into the bottle. Now is your time to really make a difference and really, really get on the front foot. And indeed, it looks like tokenization is a genie that's not going back in the bottle more broadly. I don't know if you guys saw this other story that Ondo has debuted over 100 tokenized US stocks and ETFs on Ethereum. And they also plan to expand this to 1,000 tokenized securities by the year end. It's on Ethereum for now. They intend to move to BNB chain and Solana. So fascinating story here. There is a linked one as well that in the same week, Galaxy Digital announced that it would be tokenizing its listed stock using Superstate on Solana. So there's the direct issuance of stock certificates on chain, and then there's sort of wrapping the stocks and them existing as a wrapper, but using a token on chain. So it's like a token of an ETF which holds underlying stocks. It's wrappers all the way down. Your thoughts on this, Chris?
I mean, I think this one's really close to my heart, actually. I'm originally South African, as you would know, and South Africa's got, amongst other things, is far away from everything else, but also has exchange controls. And it's actually quite difficult as a South African to access US domestic stocks. There's, 5-10 years ago, it was like really difficult. It's getting a bit easier with a few neo brokers, in the market and this sort of thing. But even now, living abroad, getting my Interactive Brokers account open up in the US, being able to try wire money there takes forever. Most of the time I get RFI'd from the money coming in. Just to buy stocks even now is still a challenge for me. And I live a lot of my life on chain, whether that's payments, whether that's, investing in crypto. So to just have access to US tech stocks and domestic stocks in my crypto wallet in a decentralized way, hopefully, and not through a centralized platform is super exciting for me. And I'm sure for many other people who've long looked at a domestic, a US stock from a domestic perspective and just not had access. So I think it's a really cool product. And I think you're starting to see the blurring of the lines between crypto platforms becoming neo brokers becoming crypto platforms. And it's going to be interesting to see. And then, companies like Ondo coming out with products like this. So I really think it's a good innovation, putting more stocks on chain.
Yeah, we also saw the Robinhood announce their sort of L2 version of Arbitrum that's initially private, but was tokenizing stocks for Europe. But Eric, it makes me wonder again, fragmentation. Is that an issue here? And or does that not matter if the audience is somebody that could never have a stock before and now they can get access to US stocks? I interested in your views there.
I think maybe three different things, right? The first one is what you said, which is the ability to access assets that you didn't have access to before, whether it's cross-border or whether it's a different type of asset that you typically don't have access to. So I think that's really interesting. The one thing we have to pay attention to is, are there real stocks that you are actually owning, right? Because what Robinhood did, if I'm not mistaken, is they did an SPV, right? So it's actually not the stock that you own when you own that stock. So people have to be careful when they invest in those things because, for example, if you get a dividend associated with that stock, in the context of Robinhood, you have no guarantee that that dividend is coming to you, right? So there is some research to do, but I am really excited because that's, to me, the next killer app of blockchain, right? The first one was stablecoin. The second one to me is the tokenization of existing assets that people understand and can suddenly access to. I think that's a really exciting development.
Yeah, there's the mirroring stablecoins. You get access to a thing you didn't have access to before. First, you get dollars that you can hold or send or receive. Second, then maybe you get some yield on that through tokenized treasuries. And third, you get access to the US stock market. It is kind of exporting things that people didn't have. But not all tokenized stocks are created equal from a risk management perspective, Eric. Your point is sage. And it mirrors a little bit of what we've seen in private markets more generally, which is the amount of SPVs going around for some of the big AI companies, for example, and there's examples I've heard of where you have an SPV of an SPV and sort of if you were ever to try and redeem that stock for cash and make them go liquid or there's some liquid, what's the chain of events that needs to happen and what are your rights and what obligations does the issuer of that SPV certificate have to you? This could get ugly, right? Like it could start to go wrong. So, what are your thoughts here? Are we going to see this just sort of play out, or like the ETF, will it just become like this whole other asset class that people kind of accept because of its accessibility?
Yeah, I think what it's a little bit ironic when you think about, I've been in this industry for 10 years. And we keep talking about decentralization, right? Decentralize. And that's what we are doing now is we are actually creating centralized platform, Robinhood, Ondo, and they're going to be the one controlling the keys of your assets, right? Yes, it's going to be on chain, but if they disappear, if those organizations disappear tomorrow, what happened to those SPVs, right? That's going to be a very interesting aspect. Today, the system works because people trust the regulators in different countries. People trust the NASDAQ and the NYSE in the US. They trust those entities, right? So before we get to a level of trust to those new entrants, whether it's Ondo or others, it's going to take time before we get there. So we have to be realistic about the volume we can expect on those platforms and the level of trust they're going to have to achieve. What's exciting to me, which is something we didn't talk much about, is the liquidity piece, right? So suddenly the liquidity of those assets is increasing dramatically because it's 24/7. It's accessible anywhere in the world. And that should create a much more liquid market, which in turn is creating more value because you can borrow and lend much faster. You can, pay and exchange value much faster. So that liquidity aspect is sometimes something we forget to talk about when we tokenize assets, but that's a very, very important one.
Yeah, that the 24/7 and instant thing is something that unless you've worked in markets, sounds like, yeah, of course it is. Everything's 24/7 these days, isn't it? No, definitely not. That's definitely not. Any other thoughts on this one, Chris? Because I think it is interesting to watch developments there and who the early adopters are. Have you seen anything in your business around where this could be flowing?
Look, we're very payments focused in our business, but I think you guys hit the nail on the head earlier around. It's an exciting tokenizing stocks, but what form that structure takes underneath is actually quite important. And what investor protections exist in the structure that's been created, are we just layering structures on structures? So it would be great to see some sort of regulation or guidance come out from a securities regulator to say, this is how you tokenize stocks. This is the way to do it. It's not an SPV on an SPV. And then that product kind of getting to market. Maybe we're a few years away from that. But yeah, I do think this trend of tokenizing everything, but this specifically, like tokenizing stocks, is a problem that's, it's been around forever. Stock settlement has been a pain. T+2 finally moved to T+1 more recently. If you now have your cash, a stablecoin, and your stock both on chain, you can do that execution and that settlement that settlement instantly. But same as early days of stablecoins, where was the backing? Were they actually in a bank account? Were they invested in treasuries? The FUD around that. Maybe that same dynamic is going to play out with these stocks as actually it's an SPV on an SPV. And do you actually own the stock? And then eventually it finds its way into a decent regulatory framework, which actually, allows you to actually own the underlying stock, get access to those dividends, and it's just on chain. So that's kind of things that I'm watching to see how it plays out.
Which is why I think what Rob Leschner's doing with the Superstate and Galaxy Digital and what they're actually taking the stock on chain. It's the stock itself. It's they have, which is exactly what we did when we dematerialized the stock certificate itself. We parked the stock certificate and we gave it a twin, which was an entry into a balance on the DTCC. Well, this is that, but again. Now that entry on a balance is parked, and then we're turning it into a token, and the stocks, we go all the way from the stock certificate to recording it as a token. Surely that is the lesson from history here, is that we can change the technology, but the issuance itself, you kind of want to see that certificate somewhere else. And you've probably had this, Chris and Eric, as well, where when you actually sell US stocks, you still eventually see a photograph of the stock certificate itself, and all of that history is still there. I don't think we're going to get away from some of those things inside of Carter and whatever else, but it does make secondary markets very interesting indeed.
I think, Simon, I think what's interesting is what you're saying is, in that context, we have to trust the parking lot, right? The parking lot where you park your certificate is going to be the trusted entity. And today, when you have a certificate of a stock, you can still do that if you want to, and you give that to someone else, right? You are supposed to go back to the issuer of that certificate and tell that issuer that you are transferring that certificate. So you have to trust somehow an infrastructure player, whether it's an exchange, whether it's a DTCC. You have to trust that. We don't have that yet in the tokenized world. We don't have a trusted entity who can do that for us, which is why I think some of the incumbents are going to come out with their own solution, because to them, they already have the trust, aspect. And for them to adopt the technology, yes, it's going to take more time, but they will eventually get to provide that service.
I think from first principles, it's really fascinating to think about the Crossing the Chasm book. And, your 2% early adopters and your innovators, will adopt anything. I kind of put the degens in that category that will YOLO into the latest meme coin and actively do not want anybody's trust. And their crypto OPSEC is unbelievable. You won't find them online, and everything's signed with a PGP key. And that's how they live. That person does not necessarily represent the entire universe, and maybe we could all do better by moving that way. I do think there's something interesting about not having one single central trusted operator of the technology, because there's this fear of platform lock-in that has held back a lot of financial institutions, I think, from going fully on cloud. And they create lots of bits of market structure to centralize middle bits of back office, but we never got that core set of books and records, set of accounts becoming something that was more interoperable, because you don't want to put all of that on one big central actor, because what if they have a problem? At least in my own data center, I know where it is. And so I agree with you in one sense that somebody like the governance role the DTCC plays, the governance role of a SWIFT, those things are absolutely needed. You need the arbiter between us, and you need the rule book, and you need somebody playing that role. But that doesn't need to be the only operator of the technology. And I think this decentralization of validators is fascinating to sort of think about. And the fee models you start to get out of blockchain networks potentially create a more interesting competitive dynamic that change that sort of platform lock-in story. I don't know if Eric, if that resonates for you at all.
Yeah, it does. And that's the pressure between decentralization and benefiting from that decentralization technology that we all have now, and the fact that historically we've been trusting centralized authorities, right? So we have to find the right balance between those two things. We will, at some point, get to the right balance. But I think my point earlier was, I think it's unrealistic to expect, a bunch of brand new operator to become that trusted set of parties without thinking of the incumbents. The incumbents will play a role in this because they own the trust today, right?
100%. I wonder, as you think about those trade-offs, I was thinking about them in sort of performance and throughput versus decentralization, but I think it's also trust versus decentralization, but also the maturity of that. Like, you could potentially have something that's trusted and decentralized, but it was more mature. These things just haven't been around for very long.
That's it.
And there's also distribution versus neutrality. So, like a DTCC has a lot of distribution, but sometimes it's quite nice to have a bit of neutrality in there and a bit of competition, and you get some potential innovation there. So there are these trade-offs that I don't think we're through the woods on figuring out just yet. But Chris, I'm interested in your views from the stablecoin market, because you mentioned earlier sort of that backing conversation has largely gone away for some of the top stablecoins. Is that going to be a question of trust now in tokenized deposits and new assets coming to market, with everybody issuing their own stablecoin? Do you think that sort of skill of being able to prove your reserves is going to be something that gets a little bit more focus? And does that look like traditional governance? Does that look on chain? What are you seeing in that sort of space?
No, I mean, I think it's definitely something everyone's thinking through. Is like, I think the one thing that has changed now is we do have these clear guidelines out of, with the Genius Act and that sort of thing on, if you did want to do a stablecoin, whether you're a federal issuer or a state level issuer, this is what you've got to do. These are the steps you've got to follow. These are the reserve attestations you have to make. I think we're seeing, Hong Kong with their own stablecoin legislation. You've got MiCA in Europe, where you can hold actually bank deposits plus treasuries, or you can't hold too many treasuries. At least, so it's effective, like, forcing it into bank deposits. So I think everyone's going to come, out with their own way, but I don't think you're going to have a credible chance of getting any sort of scale with a newly issued stablecoin if you're not following one of these frameworks, even if it's not needed by a legislator. Just because these frameworks are out in one specific country, if you go launch with very opaque reserve management and that sort of thing, your stablecoin is just not going to be adopted. So I think, Tether had that first mover advantage and were able to push the boundaries, I guess, maybe arguably in the early years of what was backed. I think that's largely gone away, and any new stablecoin just won't have that credibility stamp to it if it's not able to follow one of these.
Christine Lagarde coming out and sort of pushing for the functional equivalence, I think, in a lot of the regulation, and really hoping that stablecoins that do come out are at least closely aligned to MiCA's requirement for high quality backing. Whether they agree to the specific mix, as you say, of forcing people into bank deposits as a percentage of that, that might be where it varies. Can we get some agreement on it has to be high quality liquid assets, and under Basel we agree it's these things? I think that's possibly doable on the multilateral level, that we could start to agree that functional equivalence. I was in Zurich earlier this year, and I know that conversation is already happening between the various global regulators at the sort of the policy level. The bigger thing I would say to those policy folks, though, is if you want that outcome, then you have to start to think about the risk-weighted asset allocation of financial institutions taking digital assets onto their balance sheet. It's one thing to tell banks inside a jurisdiction that it's fine for you to custody assets. It's another thing to tell you that you don't have to accept this as such a massive liability on that balance sheet in your RWA calculation. And I mean the other type of RWA. If I'm an institution and I want to start moving stablecoins around or accepting stablecoins, I'm potentially at a negative benefit if I'm also a lender and I'm also trying to buy securities and I'm also trying to do a lot of things, because I have a specific set of boundary conditions that are set by the Basel Committee on how many of these risky assets I can hold on my balance sheet. And stablecoin or tokens and stablecoins are considered extremely high off the risk spectrum compared to what the underlying backing assets of those might be. Many years ago, I set up an organization called Global Digital Finance for exactly this purpose, to try and harmonize some of these things. Because I think about what's happening in Korea, what's happening in Hong Kong, what's happening in Japan, and just to operate a business like Chris's, it could get extremely whack-a-mole with different regulators in the near future. Sorry, Chris, I jumped in before you did.
No, I was going to say exactly what you said there. You kind of have to, for these RWA weightings and that sort of thing, you have to look through the wrapper, which is the token, and to the underlying assets and give that the same weight. Otherwise, you don't get the benefit of having these things on balance sheet and the liquidity that banks could bring to the market.
Well, and I think that's where innovation is happening outside of banks. Because, if you're not a bank and you're not under Basel III, then you can actually create stable coins, and you can actually make have some risky activities on those stable coins. You're still not a bank, but you can actually do much more innovation because of that. So that's why banks historically are sometimes struggling to innovate, because they have to comply with a set of regulations that an innovator doesn't have to.
Yeah, it's interesting. That's, I think, why you've seen banks also experimenting with tokenized deposits first. The amount of banks that will actually they'll redeem fiat and they'll help you hold a fiat balance, but it's Circle Mint and other services like that in the market that really do the conversion into tokens. That's where a lot of that happens. I think you guys do it as well, Chris, if I'm not mistaken, and help people create tokens against deposits. It's these other licensed entities. It's not the financial institutions that do that, and until that moves, they probably won't. But tokenizing deposits is a different thing, because it's a deposit. They've already got that thing, and tokenizing a deposit, as we've said before, is relatively simple. The deposit just stays there. It just gets a digital twin that gets to move around. How you make that private and secure is a whole other thing. Well, Jed, is there anything else I haven't asked you today that we think we should cover off? Because I'm conscious we're coming close on time, and there's always a lot happening in the digital asset and the tokenization space. What's on your mind, Chris? What's on your mind, Eric?
Well, I think it's been a great conversation. But Joe, I am keeping this key eye on those tokenized stocks. I think it's a really interesting story, and like I said, close to the heart. So let's see.
Yeah, I'm pulling for you, man. Hopefully those apps are going to be doing it. I'm going down the rabbit hole researching some of the stablecoin-linked cards that are out there, and some of the DeFi cards. There's some very interesting credit cards out there. Yes, from Coinbase and Robinhood, but also from EtherFi and some on Solana as well. There's some really interesting product innovation that looks like fintech, but that feels a little bit different. So I'm excited for it all. Eric, if people want to learn more about what you're doing, how do they get hold of you, and how do they find out more about the work you're doing?
So I'm the CEO of Hashgraph, which is the lab team behind Hedera, and you can find a lot of information about Hedera at hedera.com. You can find us on LinkedIn and Twitter and many other platforms. If you want to talk to me, I'm at eric@hashgraph.com, and you can find me on Twitter as well, and LinkedIn and other platforms. So yeah, that's it.
Eric, genuine pleasure having you on. Chris, how about you?
You can find us at bvnk.com, and if you want to, I'm most active on LinkedIn, so at Chris Harmse on LinkedIn.
You'll find me at SY Taylor on Twitter and Simon Taylor on LinkedIn. You'll also find me on this show same time next week. So we hope you'll go ahead and hit that subscribe button. You'll leave us a review. You'll tell all your friends to listen to this show. And maybe one day when Chris is back, we'll find out how his tokenized stocks journey is getting on for him. Please do leave a review. It helps others find the show. Thank you so much, and bye for now.